Hello, this is Coach Mike from winningstockcoach.com. I'm going to go over my market overview for the upcoming week beginning September 8th, 2014. As we've discussed over the past few weeks, we kind of had a couple longer term targets for the S&P 500. And that's the chart we're going to start out with, the SPX. After being really close, is 0.19% from the low on that last market dip where we were expecting around 1908.47. We have been anticipating the possibility of getting up to about 27.03. It's a longer term target we've had and felt we could kind of eke out the gains to there, as you've heard me say over the last couple weeks. Since we got the first 3 weeks or so of the run up since the market bounce, we began to anticipate that the market would get into a little bit of a consolidation pattern, although that consolidation pattern would have a slightly up move to it. Can make some trading difficult, when you're going 3 steps forward, 2 steps back, which is the best analogy I can make for what we've been seeing over the past 2 weeks. Up until Friday, S&P 500 wasn't looking too hot. Friday it had a really strong day, was able to close the week green, just inching forward a little bit. It does make new entries, long entries, a little difficult. It even makes short entries difficult. But what it doesn't make difficult is the positions from this bottom bounce point that you can still continue to safely hold. Now, in this upcoming week, it can be a little bit difficult to try to predict exactly each day's movement. As I switch over here to the daily chart, you're going to see that, Friday, yep, great day. The rest of the week, sideways, sideways, sideways and down, and hey, let's pop up real quick. Because of this move here, I would anticipate that you could use a support point of $2,003.37, which was this high close in this consolidation sequence that was broken on Friday. So if we continue upwards, keep an eye on that $2,003.37 for the SPX as you begin to push forward to that 27.03 target. I do have a shorter term movement target area, this 2033.81, still pretty close to that 27.03 longer term target I've had on there for a while. But I do believe that overall we see more of what we've seen the past 2 weeks than what we saw in the 3 weeks that led to that. It's pretty common in the market overall, and as I switch back to a 1-year daily chart, you see previous bounces back here. October 2013 with the government shutdown, we ran up about 3 weeks. Even though we continued upward overall, the consolidation patterns made it a bit difficult, and you didn't get much continuation out of the consolidation range break before giving a lot of it back. So my approach personally to new entries in the upcoming week will be to monitor the consolidation range breaks for shorter term trades that might last you 1 to 5 days, and take advantage of the repetition in chartable movements that we've seen. Again down here, February's dip, we run up about 3 weeks and we start going into this consolidation pattern. After April's dip and straight into sideways, we got about 3 up weeks before a slightly upwards moving but consolidating pattern. And seeing that happen 3 times in a row already has me believing that, hey, my long-term entries down here, we're good. We're good to the weekly swing point that we've now established and broken. But we need to be cautious of what to expect overall in the day-to-day movements. Moving over now to the DJIA, the Dow Jones Industrial Daily chart. We talked last week about the prior swing high and how we needed to wait for the range break above it for new entries. You know, the S&P 500 already made that break. The DJI, if it continues upwards on Monday, could actually make that break, giving a bit of a momentum trade like we saw for the NASDAQ composite stocks 3-4 weeks ago. And we talked about the range break, wait for that, play the momentum, and it worked. And then we talked about it for the S&P 500, and it worked. And the DJI could give a bit of momentum, although I don't see a lot of high side for it. I'm starting to believe that we could at least see that 17,326 that's up here, $17,306.26. But I do have a slightly long-term target of 17,209.51. That has me believing there might not be a lot of momentum seen into these points. So longer-term entries made back down here when the market dipped. We played it off of our trend line. Outstanding. No reason to sell them. I don't know that I want to go after the DJI for the same type of momentum that we got out of the NDX and SPX charts. Quite simply, as a reason for that, is going to the well too many times. If you didn't do it the first time, well, you missed those. If you didn't do it the second time, you missed those. And if you're finally on board, getting excited and ready to go, usually the market's going to throw you a curveball, and that time it won't work. So not quite sure that the momentum we see off of this, if should it break, is going to be worth the risk for whatever potential reward is there. Moving over to the Russell 2000 daily chart. This is our small cap index. I actually have a concern on this chart that, if you've been following my market overview videos for a while, we were pretty spot on calling this fall and even calling the bounce point, and we called within 9 cents of the high point. And we've been able to articulate that in these weekly videos to give you some really good plays. Now I want you to concentrate on this daily chart. You're going to see this little series of up and slight pullback up, slight pullback up, slight pullback up, slight pullback. You've seen it here, you know, as we made this new high here, we got up, slight pullback, higher low. Up, slight pullback, higher low. Up, slight pullback with a higher low. Up, pullback to a lower low than this prior one. Now, even though I've got this primarily horizontal channel on this daily chart, I want you to look at something with the Russell 2000 chart in relation to what I just outlined on this last up move. We've got up, slight pullback, higher low. Up, slight pullback, higher low. Up, slight pullback, higher low. Up, slight pullback, lower low. Now, what I'm looking at with this is, even though I think it could make a little up move, I want you to focus just on this period of time from August 25th till current and look at this up move, the down move, the higher high, this move, which returned right back into this gap area but still gave a lower low, and I would be anticipating an up move that hit this high, the high from 827, not the prior high, and a pullback from that point would be a head and shoulders technical chart pattern from your daily chart. So I personally would be cautioning on the potential of very limited upside on the Russell 2000, even should it go up. Now, to eliminate that bearish argument, simply all it's got to do is break this prior high over here at 1177.07. But I want to show you one other thing that happened with this run up that we didn't see happen until the failures on the prior runs. We had a trend line on this short-term up move, and we failed below on absolute price for that trend line, which is not always an indication that it's going to fall. It's an indication that it's no longer following that trend. So I would be watching over the next couple days for it to come up, retest the bottom area of this trend line, right about that 1177 area, and begin to pull back from it. If it does that, get prepared to short some of the small caps that have run pretty well here over the past 2-3 weeks for some opportunity at momentum trade to the downside. There's quite a few big name biotechs as a part of the Russell 2000. Zillow, which just failed its daily chart trend line, is a Russell 2000 chart. Yelp has been a pretty good move here as of late. Could have some opportunity to the downside should the Russell 2000 give that bearish chart pattern, which it has not yet. It would have to go up a couple days or so to get there. And on the pullback from it, that's where you would look for those stocks for potential short entries. Finally, now over to the COMP chart. This is your NASDAQ composite chart. We talked a few weeks back at this triple top area where, should we break above that swing point, we would look for momentum trades. We got the momentum. Now, as I tell members of the coaches roster, that everybody likes to ask, well, how do you know when it's time to sell this type of trade? Well, momentum trades are commonly nicknamed Momo trades. And just an easy thing to remember is when the Momo is no-mo, get out of it. That momentum became no more on September 3rd. It's time to get out of it. So, accurately calling the NASDAQ breakout for the momentum trade, and taking profits back on Wednesday, which a lot of us were doing at the coaches roster, on some of those flying names like Apple, Amazon, and quite a few others. Now, at this point, we have a bit of an established support. See me draw the support on here. We had a little gap in here that needed to fill. It filled it Friday and bounced. Even though the momentum trade from this breakout is over, that does not mean a new momentum trade cannot happen. But on the retest now of support, I wouldn't expect exactly a new breakout on momentum. I would expect just a normal type swing as to where you now have an established support point to serve as your stop. This is Coach Mike with WinningStockCoach.com, encouraging you to have a plan for every trade. Make sure you're analyzing the risk of every trade to a greater degree than you are the reward. Best of luck, and God bless in this upcoming week.